is on line 34. On line 34, you see RRSP deductions. Okay, RRSP deductions. So basically you can deduct RRSP on 34. What happened is if you total income is 100,000, then if you 100,000, then your contribution RRSP is come to 30,000. So that's basically, if you don't have another deduction, then basically your net income is 70,000. Okay, so the you said RSP is good for you, is bring your income down, right? Bring your net income down. So we know net income is calculate tax credit and calculate social benefits. So that they directly bring your income down. And there's lots of people like it. That's big advantage. Okay, you know, this bring your net income down. That means when you the net income, like for example, they calculate the child care, Canada child benefit. Canada child benefit, they just refer is your family net income. So even like, for example, even like your income is 100,000, right? It's 100,000, but if you have enough room, first thing, okay, have enough room, then your contribution RSP, then you bring your income down 30, then you comes to 70. If your wife doesn't have any income, then your family still qualify for the low income. Then you get probably you get most, I believe, is under 90,000, and the family. Even you have even you only have one child, so you still get the child benefit, Canada child benefit. So that's it's good things. And also the net income we calculate. The net income is we calculate the tax credit when we do medical expenses. They subtract your medical expenses credit is subtracted 3% of your net income, right? So that's net income is good. If you bring down your net income, that's very good. Then also if your contribution 30,000, so these 30,000, do you pay the tax on this 30,000? Do you need to pay the income tax on this 30,000? So this one is net. Yeah, no, because this one is net income. You already subtract. It's 100,000, for example, 100,000. Then your contribution 30,000 on RSP on 34. RSP is line 34. Then you subtract. If you don't have another discount, deduction, then you come to 54. 52 is 30,000, is 70,000. So 70,000. If you don't have another one, then you come to the taxable. Okay, the taxable. Where's the taxable? So this one is the line 66 is taxable income. So that's a tax income if you don't have another deduction on this line. So 66 is your 66 is on 66 is 70,000. So they 70,000. Then they go to this go to 15%, and part of is the 20. Part of it is 20.5%. It's something like that. Okay, so instead of 100,000, you have to pay full amount 15%, full amount of 20.5%, and the part of amount is 26%. Okay, so when you contribution 30,000, you won't get anything on 26%. It's a part of something, it's a 20.5%. Okay, full amount 15%, and part of is 20.5%. So it's something like that. But this is the contribution. Okay, when you contribution RSP, you pay less tax, you save tax, right? Then, but when you withdraw RSP, okay, when you withdraw RSP, you want to take money from your RSP. You take money from RSP, you need to pay the income, because that money, like for example, that 30,000, that 30,000 is your previous income. You never paid the tax on 30,000. Now you want to withdraw RSP. You want to withdraw that 30,000. So these 30,000, you need to pay the tax now. So withdraw anything, withdraw RSP is on line 16. On line 16, that's RSP income. We call the RSP income. So the guy is take care of your RSP account. They will give you a T4 RSP. Okay, basically what they're doing is they just directly deduct 30% tax. For example, if you take you withdraw your RSP from your account, then the bank, okay, if you put money in the bank will give you 7,000. Then 3,000 is for the tax deduction, but the tax, you can do the tax refund. Probably you get refund for that. Okay, you're doing the tax, file your tax, calculate. Probably you get tax refund. But anyway, if you want to withdraw 10,000, you only get 7,000 by the time. Okay, they automatically withdraw that 30%. So this is not, the lots of people don't like it, right? It doesn't like it. I don't like it. So it's very painful. So when you want money, you only get 70% of that money. That's the one. So for lots of people, for me, I think that the money is died when you put the money in there. Okay, when you put money in there, then if you want to withdraw money, that's very painful. So you forgot it. So I just forgot it. Okay, forgot it. Then I will discuss with the last topic. Okay, so I tell you, RRSP is government. They set up registered retire saving plan. So basically what they're doing is when you contribution RSP, then the contribution, this money, you don't need to pay the tax. Okay, you put the RSP account, you don't need to pay any tax. And also the good thing is when you're using this RSP to do the investment, like like the day before we discussed, you use that RSP money to buy the stock, to get dividend, to get the interest. You purchase stock, then you sell it, right? The RSP. Then this money, you don't need to pay any tax. Okay. Then my friend, she just used her husband's RSP to purchase like Tesla stock. Like I tell you, purchase Tesla stock. Then she got lots of money. The money is grow very fast. Then I said, the lowest one is 400 per share, 400 for share. Then she purchased, but she tell me she just very regret. Okay, she tell me it's not very much. I just purchased a few of them. Okay, that's what he said. The lowest one is 400. Then after she got 600 and 800. Okay, the highest one is 800. You know, let me check now today, how much today. At the beginning of this year, the Tesla's stock is, they come to 1,400 per share. So let me check how much today now. Okay. Tesla stock today is $1,089.80 per share. Okay, the gross loss that day I'm talking to you is $1,003 or $4 around. Now it's $1,089 now today. Okay, so that's gross loss. You see, her lowest one she purchased is 400, and the highest one is 800, right? So now it's grow 1,089, close to 1,090 now. So she make lots of money. So if she sell it, okay, sometimes she sell it. She said as long as they come to the 1,000, she's going to sell it. Then after wait for come down. That's what she tell me. So even she sell it, she make money. Then this we said is capital gain, right? For example, she sell 10 shares. So we just simply calculate is 600 because she got 400, 600, 800. Okay, so we just put in the middle 600. So the 600, then today, then the per share she got almost 490 per share, right? Today is 190. So if she sell today, so per share is 490. So 10 share is 4,900. So this 4,900 we said is capital gain. Capital gain, then you need to pay 50% of tax on it. Capital gain is 2,450 times whatever her rate, whatever her husband's the rate, right? But she used that RRSP to do that investment. So she make money, she don't need to pay any tax. So don't pay any tax until, like say, that's the 4,900 until he withdraw. Okay, until she withdraw money from RSP account. So she, for example, she withdraw money from RSP account is 10,000. So they are so the system and the RSP account, they don't care. Your 10,000 is from your contribution or from your growth. You use that contribution to investment, then the growth, right? From this 4,900 is something is 4,000. The growth is 4,900, and the principal is 5,100. They don't care. They just put the total money, 10,000 is on line 16. Okay, on line 16. Then according to her husband's another employment income and the other another income, then you pay the tax, the calculated tax. Okay, then also like I said, if you withdraw 10,000 from your from her husband's RSP account, they just the bank is subtract 3,000, so you only get 7,000. But actually you get 7,000, but you pay the tax on box 16 is 10,000. Okay, is 10,000. Then 3,000 is like we like here it is page is line 148. 148 is the same thing is line 147. Okay, line 147 is the same thing is you got the tax deduction from your paycheck. Okay, your employment paycheck. Okay, the same thing. Line 147, then the system is calculated. You got balance on, or you need to pay tax refund, something like that. But it's still painful, right? The good thing, I said again, the RSP, the good thing is your contribution. Your contribution, then you don't need to pay tax, and not only that, then you use RSP to do the any investment. So the any investment income is tax free. You don't need to pay any tax. What time you pay tax? Until you withdraw RSP. You withdraw RSP, you pay the tax. Okay. That's basically is that. So yesterday I asked a student to check that your RSP limited room on your notice of assessment. Is anybody doing that? Is anybody doing that?
Yes, ma'am. It's
okay.
on
You
page
did.
3, ma'am. Page
you
3.
find out. You find out, right?
Yeah, page 3.
The page 3. Yeah, you find out. So so now I just show you here. Okay. So the basically is here. So did I see that everybody see my screen? And the RRSP limited. So when you're looking up your when you look up that your RRSP, see my screen here. I just got Google to search, okay? So that in your RSP, the notice of assessment, so they just give to you RSP deduction limited for 2019. That one is 2018 notice of assessment. They give to you contribution limited room for this one. Oh no, this one is 2019. Sorry, this 2019 notice of assessment. So this says RSP limited room is for 2019. Then they minus RSP contribution. Then they calculate, like I said, they also, after this says RSP limit deduction limited for 2020. So when you look up 2020's NOA, they will see RRSP deduction limited for 2021. Okay, you need to find that number is for 2021. So when you contribution RSP, you need the contribution RSP is not limited. Okay, it's not whatever you want to put. Is they have a limited room. So like RSP limit, if RSP limited room is 5,000, if you contribution 6,000, so they only give your deduction is 5,000 because your limited room is 5,000. Okay, so that's the calculation. Calculation they increase. In 2019, they subtract your subtract RSP contribution deduction for 2019. And then they give to you like say they give you 18% of 2019's the 2019's income, okay, earned income. So and the system is automatically give to you 18% of 2019 earning the income, then the maximum is 27,230. So that's every year. Maximum they give you increase is 27,230. So anyone is 18% of your current year that income. So so this means every year increase. If you don't have earning income, of course you don't have a RSP limited room. So the earning income is including your employment, self-employment, okay? Is not investment income, okay? That's not investment income. They give to you something like that. But anyway, the calculation is the CRA give to you is the NOA, okay? Is NOA. The system is automatically give to you. So you need, when you do the tax return, if you already contribution your RSP, then you do need to find out this line, okay? RSP deduction limited for 2021, okay? Basically is okay. So here. So what you're doing is because they have a Schedule 7, right? So you're doing Schedule 7. You have to fill out the Schedule 7. So if you, the easy way is I tell you, you can double click on here. Double click on here. So the first
Excuse me, Miss Ellen, are you
yeah.
sharing screen?
Oh, sorry. So you see that's the line 34, okay? Line 34, you see my, I just open Cindy's file, okay? For example, if Cindy contribution RSP, okay? Every time when you open file, you need to know which file you're working on, okay? Don't put I give your errors information, but you actually put Cindy's on the Cindy's file. So it won't get won't write. So most important things, okay, when you do the tax return, the first thing you need to make sure whose file is open. So now Cindy's file is open, okay? For example, if Cindy have a contribution, RSP, then what you're doing, easy way you're doing is double click on 34 because they says Schedule 7. You can find the Schedule 7 here, but I just ask this easy way. Easy way is double click 34. You double click on that. Double click on that. Then the first one, okay, the first line, the yellow one, first line. So is RRSP deductions limited room for 2021. That's I just show you is on NOA 2020, right? NOA 2020, you will find out your RSP limited room. You put here. For example, Cindy's RSP limited room is 8,000, for example, okay? Then the 8,000, what 8,000 come from is come from her notice of assessment 2020. Then the 8,000. So now here, between March 2nd to December 31st, 2021, okay, 2021, between this time frame. So between this time frame, then I click on here. Because this one is a white one, you cannot, only yellow one, the yellow background, then you can put the number directly. But the white one, you need to click on that button, then you put this one. For example, in 2021, from March 2nd to December 31st, okay? So that's RRSP contribution time, okay? So in 2021, then between March 2nd and December 31st, then Cindy is contribution 4,000, for example, okay? Contribution 4,000. The 4,000. Then description is, you need to put description. So description is who take care of this money. So 4,000 is where you put it. Okay, so where you put it, some bank or the bank or there's a financial institute or financial group, something like that. Okay, and also somebody put like somebody put like that's A, B, C financial group. Okay, for example, ABC financial group, then through the employment, okay, through they just through the employment because there's the group employment, right? The group employment because there's I know some employer, they provide RSP. Like say, if you contribution RSP as 2,000, then the employer that match that 2,000. So they give you 4,000. Okay, so your RSP account is 4,000. That's the employee they give to you. Okay, give they match you 2,000. So actually, when you got is you have a 4,000 in your account, but employer give you 2,000 is already including your line one. Okay, line one is a taxable benefit. You need to pay the tax. You need to pay the deduct. They already deduct the EI and deduct CPP. So it's this one is no, they sorry. Okay, again, they deduct CPP, not deduct EI. Okay, because it's not insurable. Because this one is not cash benefit. It's non-cash benefit. It's only they deduct tax or they deduct the CPP and deduct CPP. That's it. It's not insurable, not deduct EI. So you put an ABC financial group through your employment, right? Through your employment or through employment. That's the one, 4,000. Okay, so 4,000 again. These 4,000, again, these 4,000, you don't need somebody. They put time on here. This one is not medical expenses. You put time is okay, but you don't put if you don't put time, is acceptable because they already give you a time. That's the button. Okay, this one, the button here is from March 2nd to December 31st. So description is only description. I only want you put that who is the plan, who take care of your plan. Okay, where you put the money there. The money goes where? Okay, that's the description. This one you already have a time. Okay, so between January 1st to March 1st, 2022. Okay, 2022 is so RSP. Everybody, if you know your contribution RSP for 2021, so the deadline is March 1st. So the last day is March 1st this year, right? This month, the March 1st. So the bank guy is very busy March 1st. So you, if you, they just got overtime. So between February 28th to March 1st, they are very, very busy. Okay, they're very, very busy. So the deadline is March 1st. So in this period, in 2022, then he still, in 2022, Cindy still can contribution RSP in her tax return is 2021, right? So in here, then what happened is he got, for example, he got another 5,000. He got another 5,000, but this one is he is not through for not go through for to her employment, not the group plan. Okay, the employment is group plan. So this one he just put on RBC account, RBC bank account. So that means you that means RRSP, you can set up more than one account, not stuck on one. Okay, if you contribution RSP, you can put any bank, okay, more than one bank or more than one group, but the total must limited here. You have to be careful. It's limited 8,000. So that's basically her room is 8,000, but you know, she contribution is 9,000. Okay, so 9,000. What happened? You see here. Then the deduction only 8,000. Okay, why? Because the room is 8,000. You put 1,000, then you put 1,000 more. She put 9,000 here. So she put 9,000 here, then your deduction only 8,000. Okay, something like that. So and also I will for this case is this case is Cindy is we says is over contribution. So we RRSP they have over contribution they have an over contribution policy. Okay, any registered plan they have an over contribution. So if you over contribution, sometimes you get a penalty for that. Okay, but this 1,000 they won't get. The 1,000 is you just put money in your RSP. That's it. And 1,000 is not. I'm going to talking about that. Okay, if you over contribution is somebody can get over contribution. So why people over contribution like now, like Cindy? If Cindy is her room is 800, but she contribution is 9,000. So the 1,000 is over contribution. Why? Because why? Because you know why is because you put more money in there. Some people they want to use that RSP the money to do the investment. So the investment that they grow is tax free, right? Like my friend, if she need purchase more Telos stock, then she needs money, right? So she's contributing more money on RSP account, then they use money to purchase Telos stock. That's it. That's basically this one. So how about if you just put, I just forgot, okay? I just forgot. If you have 8,000 limited, but Cindy only put 4,000 here. Only put 4,000 here. That's it. It's only through that employment. So what happened? Then she limited room is 8,000. Then she contribution is 4,000. So the deduction is 4,000. Okay. So whatever your contribution, then deduct 4,000. Okay. This one is basically it's very easy when you do RSP. So that's the basic information. Okay, when you withdraw RSP, then the bank will give you T4 RSP. So T4 RSP, then they will tell you the total money withdraw is on line 16. Okay, that's income on line 16, and the total money is on line 16. Then they subtract your tax. Okay, they subtract your tax. They will give you the number is box. I believe it's box 20 or something. So that So you directly put on that 147. The line 147 is here. Okay, the page 8, 147. So that's basically how they do. So and also there's RSP. Also RSP, they have a spouse RSP. So you can open your own RSP account and open your spouse RSP account. So that's people. Why the people doing that is if somebody, right, if some, why the people doing that is government allow you to do that is, for example, the doctor or lawyer. Okay, I said they have a very high income. So when they withdraw RSP, so when they with contribution, so when they contribution RSP, so they can deduct from their, they can deduct their net income, right? So net income, eventually they deduct their taxable income, so they don't need to pay the tax, bring their net income down. For example, the doctor, then he makes 300,000. Okay, total income is 300,000, but he contribution RSP is contribution RSP if they have a, if he has enough room. Okay, if he has enough that limited room, then he contribution 100,000 in RSP. That means bring his tax income down to 200,000. That's much better, right? But 100,000 he not put in his own, not put his own RSP account. He put the spouse RSP account. So spouse is his wife's RSP. So his wife basically stay at home. And for one day, the RSP, they just set up a rule. After 3 years, then his wife withdraw RSP, right? Withdraw RSP, then we know that's 100,000. So these 100,000 is come to his wife's T1 box, line 16. So on line 16 is his wife's, okay, T1 line 16 is 100,000. So these 100,000, then of course the 100,000 he only gets 70,000. But anyway, so total is 100,000 on 16. Okay, I said actually he get money is 70,000. It's not 100,000, but your income still 100,000 because they got 100,000 withdraw from your RSP. So 100,000 on line 16 of his wife's income. So these 100,000, what they paid is part of 15%, then the part of 20.5%, and the small amount of 26%, right? That's 100,000. But before the 100,000, if the 100,000 on the husband's title, so 100,000 he saved. I said the husband is 300,000. Then he got 100,000, and he is contributing 100,000 RSP. So these 100, if he doesn't contributing RSP, so these 100,000 if on husband's title is 33%. Okay, because it's is 300,000. So 300,000 is on here over 200,019. So the most part is 33%, and another one is 29. Few of them is 29%. Okay, so that's they save lots of money, right? He paid is most one is 33% and part of 29%. But then if he put RSP on spouse account, when spouse withdraw that RSP 100,000, the spouse only pay 15% and 20 decimal percent, and a little bit 26%, because 26 is 98, right? So over 98 is 26%. So he saved a lot of tax on it. So this is why, okay? This is why the people contributing spouses RSP. Okay, so you could, like this doctor, he could contribution on his RSP. He could the contribution on his spouse's RSP. So any RSP he contribution is its deduction is on his T1 34. Okay, anything on T1 34. So that contribution is have to limited room in your limited room. Okay, so in your limited room, then the doctor he has two choice. Everybody have two choice. You can contribution your own RSP, or your contribution your spouse's RSP. So most time, if your spouse's income is low, then your contribution your spouse's RSP is beneficial. Okay, so when this one is good when you withdraw. Okay, when you withdraw. And another thing is when you withdraw, that some students, they confuse. They said withdraw, you have to wait until your retirement. It's not necessary, okay? Anytime when you withdraw, you pay the tax. So the CRA don't care what time you withdraw. You can withdraw next year, like this year, your contribution. Then you withdraw next year, because next, lots of my friends, they did is because, you know, in 2020 or 2019, sometimes the oil patch is in Calgary, in Alberta, it's not good, right? Before, in 2016, 2015, the oil patch, they make lots of money. One of my friends, they make, the couple, the husband is 170, the wife is 150,000, okay, every year. So in this time, they just contribution RSP. So after in 2019, they both get laid off. They don't have a job until now. The couple still at home. Okay, there's no income. So in this case, they just because they need money to survive, right? So they just withdraw RSP. Okay, so when your income is low, or when they need money, then they withdraw RSP. So they withdraw RSP, they just put a line on line 16. They paid line 16 because they don't have no income, so they just paid is some 1,000. You pay a part of money because everybody has basic amount, right? Other than basic, everybody has the basic amount. Like we said, this one is 1,000. So the basic amount 74. So less than 1,000, that's 13,000. Then you don't need to pay RSP. You don't need to pay the tax. Less than that, you don't need to pay the tax. If you're over that, then you pay tax, right? So you need to pay tax. But if they withdraw 20,000, then they only pay 6,000 something, 6,200 something, and on the tax. So that's good, right? So and the same thing when you retired, you don't have lots of income, then you use RSP money. The RSP withdrawal is anytime you withdraw RSP, you need to pay the tax. So it doesn't matter is you retired or not retired. You anytime if you need money, you withdraw RSP. You just pay the tax. CRA doesn't care. Okay, so this RSP, okay, withdraw. There's no time limit. I'm going to after that, I'm going to talking about RESP. So for the RESP, you You have to waiting for your kids to go to school, go to secondary school, like college or university. Before that time, you cannot withdraw. If your daughter and your son not go to college, not go to university, you cannot use that RESP money, okay? Until retired, you can transfer that money to your your RSP account. That's not another story. That's RESP. You withdraw only is for tuition. Okay, if you don't have a secondary education, then you are not qualified to withdraw that money. But RSP is okay. Okay, you can withdraw anytime, as long as when you withdraw, you need to pay the tax on it. So you need to put on line 16. That's it. Okay, so now we are basically is this one. So now I will look.
Ma'am, sorry, question.
Yes, yes.
So you're saying if the RESP wasn't used up, you can transfer it to RSP?
Yeah, that means until if your RESP, I'm going to talking about later. Okay, RESP is a registered education saving plan. So they only for your kids is go to secondary school. So, but if your kids not go to that, then you can. If your kids is for some reason, okay, for any reason is for the physical, like they are infirm or they just they have some disability, they are not able to go to that school, then they then they allow you to withdraw. You can withdraw, okay, or you withdraw, transfer, or you transfer to your RRSP account. Yeah.
Okay.
But
Thank
if
you.
you have a limited room. Yeah. So
Ma'am, that's anytime, or you have to wait until they are 18?
Yeah, you have to wait. Not 18. I think if wait 18 is you have to some doctor notes or something proof. It's not your kids. It's because the kids is not go to secondary school is some physical mental reason, and otherwise, you have then you just withdraw that money. Okay, otherwise you allow you to do that. But for lots of things, RESP, because RESP is not is nothing to do with your T1. Okay, it's nothing to do with your T1. So basically it's not including my model. But if you want to know, there's lots of detail, and you can talk to the bank guy. And the bank guy, of course, they know much more better than me. Okay, they knows how you see if I contribution are ESP, but I eventually I cannot use that money. So how should the fund go? Okay, they will tell you. Okay, RESP. Okay, this one is 34. 20700 is 34, line 34, okay? The pension plan. No, this one is RRSP. So RRSP is excellent tax deferral mechanism, especially suitable for taxpayer. So that I said is the tax deferral is you pay tax later. When you withdraw RSP, you pay tax. Contribution RSP, that money is not, you don't need to pay any tax, right? So it's except then escape the tax when you withdraw RSP. Like withdraw RSP, when you contribution RSP, for example, it's 20,000. So these 20,000, you don't need to pay RSP, of your income, right? Of your total income. If total income, you withdraw 20,000, then the 20,000 is deducted from your net income, and eventually it's taxable income. So you don't need to pay tax. But when you withdraw RSP, in that time you pay tax. So that says a tax deferral. It's not tax free, okay? It's a tax deferral. Eligible RSP contribution are deducted directly from your income report on T1, okay? On T1, line 34. So which is that means your contribution save tax at the current year tax rate. Like I explained to you, you save that the doctor, they save his tax. So his tax is current year tax rate. So if your current year tax rate is high, that's the good. You contribution RSP, then you save loss, right? So like I said, there's one of my friend, when they contribution RSP, they save 26% because they are on 157, 170 something thousands that income. So when the contribution RSP, they save 26%. That time the tax rate is 26%. When the contribution RSP, that money is at 26%. But for example, last year they withdraw RSP, or this year they withdraw RSP because they don't have a job now. They got laid off. Basically they don't have any income. It's just rental income, okay? That only just rental income, don't have another income. So in that time, they withdraw RSP, they only pay 15%, okay? Because they are under 49,000. So they pay 15%. In this case, they save tax, right? They save tax. So that means the contributors save tax at the current year tax rate, okay? What is eligible RSP contribution? Like I tell you, eligible RSP contribution is you contribution within limited room. Like Cindy, she has a limited room is 8,000. So anything 8,000 is if she contribution 8,000, contribution 5,000, 6,000, that's all can directly deduct. But if she contribution 9,000, then only 8,000 can deduct. So that means we said eligible RSP contributions. Okay, the eligible is there's nothing. It's only you have to contribution in your limited room. In addition to the initial tax saving, because your saving tax, initial tax saving received when your contribution made, the all income earned by investment with RSP accumulate tax-free until it withdraw. That means they says all the investment income within RSP, that you use RSP money to do the investment. So the investment income, you don't need to pay the tax, okay? Accumulated is tax-free. So it's tax-free until when you withdraw RSP, you need to pay tax. So when you withdraw RSP, they don't separate like what the money is initial and your contribution. What the money is you from your grow up from your investment income. They don't care. They just whole money. When you withdraw, whole money is put your income. Then Okay, so because that's income earned by RSP accumulates tax-free. Okay, because the investment income, like I said, investment income is tax-free. You don't need to pay tax. So the capital grows more rapidly than the capital invested outside of RSP. Okay, so this creates large investment fund to provide the income for retirement or other purpose. So um, like I said, for example, my friend, then she is using her husband's RSP to investment in Thales stock, right? And the Thales stock, for example, then I give you example, if she sell 10 shares, then basically she make 4,900. Then plus before, that's RSP, they grow very fast. Okay, they grow lots. So now, so far, she doesn't pay any tax on capital gain, on whatever. Okay, she doesn't need to pay anything until she withdraws RSP. She wants money from RSP to pay. Now he doesn't need to pay anything. When she make 4,900, he put it over there. Then he purchase another stock, or when the Tesla stock a little bit going down, then he purchase more. Then they will then they will goes up again. Okay, so I think Tesla stock in the announcement is in summer, August or something. The Tesla stock is going to split one to 4. Okay, so in that time is probably they going up again. So but I tell you, I don't have time to watch out that stock market. I don't put any money in stock market. So so don't ask me. There's some student, they ask me which one is the best. You put which stock is the best. You make money. I is Indian. I have no knowledge for the stock market. I just heard from my friend. Then she said there's Tesla. Lots of people get Tesla stock. They make lots of money. Okay, that's what I know. That's only what I know. There are lots of people, and this one is this RSP. That's basically RSP, how they works. So your RSP issuer will give you a receipt for the amount you contributed. Then you use this receipt to do tax return. Okay, they will give you a receipt for amount you contribute by the end of March. They will give to you. So that's the best thing is the best thing when you keep in your mind. The best thing is you prepare your tax return is now. Is by end of March or beginning of the April. Don't do the tax return early. Okay. Sometimes but if you don't have a RSP, you could do in the middle of March, but don't earlier than middle of March, because some T4 and the T4A they comes in later, especially for T5. Okay, so the bank or the financial the financial institution, they just come late because the deadline is end of February, right? The deadline is end of February, so they just come to late, very late. So the earliest one is in the middle of March. Okay, now is the good time. You could prepare your tax return now. If you contribution to your own spouser and the common laws of RSP, okay, that I said you can contribution to your own RSP, and you could contribution to your spouser and the common law RSP. Then the receipt should show your name is a contributor, and your spouser and the common law partner's name is annuitant. So so that's if you contribution your spouse's RSP account, then then the contributor is also you. Then you can deduct on your tax return. Okay, you deduct on your tax return. Is limited by your how much room you have. Okay, that's the year you turn 71 is the last year in which you can make a contribution to your own RSP. Okay, when you turn 71 years old, then that's the last year you're contributing your own RSP. The amount of RSP contribution that you can deduct on your T1. Okay, otherwise you cannot deduct. So if you cannot deduct, then you lost your room. Okay, so make sure you use your RRSP contribution before 71. Okay, before 71, then you can deduct. Otherwise, you cannot deduct. Then if you have a RSP room, then you lost, right? When you're 72 years old, you says, I still have a RSP room. Your RSP limited room doesn't make any sense because you cannot, if your contribution RSP, you cannot deduct. We want RSP we just like it, is you can deduct on your income, right? If you cannot deduct your income, it doesn't make any sense for you. Okay, I'm going to talking later this one. Okay, for 2021, it's based on 2020. For 2021, it's based on your 2021 RRSP deduction limit. So it appears on your latest of assessment or reassessment. So that's RRSP, your 2021 RRSP deduction limited room is on your 2020's notice of assessment or your notice of reassessment. Okay, you cannot claim the deduction for the month you paid for administration service for RRSP. Also, you cannot deduct the brokerage fees charges to buy and disposal the securities with the trust of our RSP. What this happen is when I am talking about if you're using your saving account, any account, bank account, okay, we discussed before, right? And when you're using your money to do the investment, so that administration fee, management fee. Do you remember? We can claim carrying charge, right? We can claim on carrying charge. Carrying charge is on line 43. Do you remember on line 43 we have a management fee is in T3 something, right? So when you stock change, purchase stock, and then you sell stock, so the stock change. So when you paid that transaction fee, so you can deduct from your capital gain, right? So this one is we just talking about is investment, because the investment income we report on here. But now RRSP, you cannot deduct that fee. Okay, for the RRSP, you can deduct that. You cannot deduct all these fees because you can deduct these fees because the income, because the investment income, you don't need to pay the tax right now. So in the current year, you don't need to pay any tax. So they are not allow you to deduct. Also, if you want contribution RSP, you have to borrow money. Okay, you borrow money from your line of credit or borrow money from your bank, anything. So these interest that you paid, you cannot deduct. Okay, you cannot deduct the interest that you paid on the money you borrowed to contribution your RSP. So the contribution, like for example, your contribution RSP is 20,000. So this 20,000, you really need to put money in there, in the bank. You don't have a 20,000 on your saving account. So the lots of people, they just borrow this 20,000 from the line of credit. So the line of credit, you need to pay the interest on it, right? So this interest, you cannot deduct, okay? But if you if you borrow money from your line of credit, 20,000, then you use that 20,000 to do the investment, like your not RSP, okay, not contribution RSP. I use that money, 20,000 is for investment. I just purchased Tesla's stock. Then this interest that interest you can deduct, okay? That interest you can deduct. But the money, you borrow money for contribution RSP, you cannot deduct, okay? The money, do you remember the money we borrow that money to purchase stock? Like for example, my friend, he doesn't have enough saving on her account. He just borrow line of credit, that money, 20,000 to purchase Tesla stock. So as long as per Tesla stock, so the interest he paid, she can deduct. So this deduct is on line 43, okay? The deduct is on line 43. Line 43 is here. Line 43, carrying charge and the interest expenses. This says interest expenses and line 43, okay? I hope everybody can remember line 43, how line 43 work. So you double click line 43. Then for the management fee is on second page, okay? That's here, carrying charge and interest. So if if you're using credit, line of credit, to purchase stock, then the interest you paid is put on here, okay? Line 2. Then if you are paid management fee, that's the management fee is the bank charge you because they take care of your investment account. So that's we said that management fee is carrying charge. So you put the line 3, okay? The line 3 is here. But now we come back to RSP. So RSP, if RSP incurred, the bank is charging you, I think the TD Waterhouse. The TD Waterhouse, if you put money in TD Waterhouse, so every year they charge you RSP account is 100 something. So that 100 something, the management fee. So this management fee we call you cannot deduct here, okay? You cannot deduct here because it's related to your RSP account. So then also if you borrow money from bank to contribution your RSP, then the interest you paid, you cannot deduct on line 2, okay? You cannot deduct line 2. The reason is because RSP, the investment income from your RSP is tax-free. So anything tax-free, you cannot deduct expenses, okay? Continue. So generally, the total amount you can deduct on line 34 of your 2021, the income tax and the benefit return for the contributions you make to your spouse and the common law RSP, okay? Then your RSP cannot be more than your 2021's deduction room. Okay, so that's they're talking about the spousal RSP. If you want contribution your spouse's RSP, then you can deduct your own RSP in own T1 on your line 34 on T1. That means reduce your net income, right? Then, but is still limited by your RSP room, deduction room. If you don't have RSP deduction room, then you still cannot deduct, okay? Your contribution, your own RSP, or your contribution, your spouse's RSP, all limited to your RRSP room. If you don't have that room, so you cannot deduct. Okay, that says if you cannot contribution your own RSP because of your age, because you already turned over 71, already over 71 ages, then you can still contribution to your spouse or common law RSP until by the end of the year they turn 71. If your spouse and the common law partner is younger than you, you already over 71, so you cannot contribution your RSP, right? So you cannot deduct your RSP. Even you have a room, but you cannot deduct that. Like I said, in the last year is 71. But now if your spouse is younger than you, then you can contribution your spouse's RSP. If you have an RSP room, then you still can use it, right? So in this case, then you can use your RSP room. Then you can reduce your income. So the contribution made after death, the contribution the dead people. Okay, so for the people deceased that they have they need to do the last return. Okay, they need to do the last return, and then the representative still can, if they have a contribution room, they still can contribution RSP. Okay, if they are younger than 72 years old. Okay, so you still can do RSP. So I don't want to go through this one. Okay, so that's if your contribution to your spouse and the common law RSP in 2019, 2020, or 2021, then you may have to including your 21's income when you spouse's common law RSP withdraw the fund. So I said, you contribution your spouse's RSP. So your spouse has to wait after 3 years. Okay, after 3 years they withdraw RSP. Then your spouse is report the income. Otherwise, if you are not over 3 years, then you have to report. You have to report that income. Okay, I just give you an example. So after this example, we just take brief. Okay, in May 2018, Joshua started contribution to his wife, Carrie's RSP. Okay, he contribution following amount to her RSP. In 2018, Joshua is contributing 2,000. That's 2,000 goes to Carrie's RSP. Okay, there's Carrie's RSP, spouse RSP. Then 2019 is another 2,000 goes to Carrie's RSP. In 2020, then the 1,000 goes to Carrie's RSP. Okay, Joshua has contribution total is 5,000 to Carrie's RSP. In 2020, Carrie withdraw 4,000. In 2020, withdraw 4,000. So for her spouse's RSP account. So these before 2020, he has no. Before 2020, he has no withdraw any amount from her spouse and common law RSP. So that's 4,000. You know, that's 4,000 is earliest one is 2018. Another one is 2019. That's the earliest one, right? So they still within 3 years. So 2000 in 2020. In 2020 withdraw RSP. So 2019, 2018 is not over 3 years. Not over 3 years. So in this case, Joshua will put 4,000 on will put 4,000 on Joshua's T1, line 16. Okay, Joshua will report that 4,000. Okay, not carry. It's carries RSP, but carry withdraw that 4,000, then Joshua will report that. Okay, you understand? But if they have another RSP before, then probably it's okay. But now there's no RSP in 2017, 2018, 2016 or something. So within 3 years, then Joshua need then need to report that. Yeah. So another question, what is a divorce? That's bring out the question that if they divorced, in 2020 they divorced, for example, in 2021 they divorced, okay. So in 2021 they divorced. If they draw 4,000 there, okay. Make simple is in 2020 they divorced, okay. In 2020 they divorced, so the 4,000 they withdraw. Then they withdraw is because they divorced. It cannot go back to George. Is Carrie withdraw 4,000, then Carrie need to report that the income, okay. Carrie is put 4,000 on her line 16. You understand? If divorce, then they won't ask you 3 years. Okay, they won't ask you 3 years. As long as you you have a couple and that relationship existed, then you have to follow 3 years. Okay, that's the RSP. That's RSP spousal account, and I said RRSP spousal account is when you divorce, you cannot ask this money back. Like for example, Joshua, he contribution this money, okay, 5,000 this one, but somebody the contribution loss, okay, 20,000 or something. That's if they divorce. So you cannot say I can't. You in your spousal RSP. There is 300,000 there. So when you divorce, you just calculate this one. This one is not your property. You can divide. You can when you split when you divorce, you cannot count that money. So this money is for carries. Okay. You go to court. It's not you discuss with this one. So that means your spousal, when your contribution to your spouse's RSP, my suggestion is you have to confidence with your relationship. If your relationship is not stable, don't contribution your RSP in there. It's then you lost money. Okay. Like I said, that friend, she is doing she's contribution, she's purchased stock, and she's purchased that Tesla stock, right? The one day, because she basically is housewife. She basically housewife. She only have rental income. That's nothing. She stay home mother. So one day, I don't know when she's my close friend, but we never talking about. We just never talking about my job. Okay, sometimes I don't talking about my job unless you ask me for the for the taxation question. Otherwise, I won't give you a lecture for my friend. Never. Okay. Then one day she find out they have a spousal RSP. Because what she know is she doesn't have an employment income and the self-employment income. So basically she knows she don't have a RSP limited room. So she thinks she has no RSP. So, but one day she heard about have a spousal RSP. Then she's get mad. She asked her friend, asked her husband. So you are able to contribution spouses RSP. Put money in my account. Why you don't do that? Then her husband says, that's the same thing. Okay, I put my RSP account and put your RSP account, the same thing. Because you put your spouse's RSP, you need to open account. Okay, you need to open account is spouse RSP account. Then she doesn't have spouse RSP account. Her husband never go there. Then she's mad. Then because she knows, I know that income tax. Then one day she come to me. He asked, "Is it true or not?" And because he heard her husband is able to contribution spouse RSP, then I just talking to her. I tell her, yes, your husband can contribution spouses RSP. Then I just talk to give her a lecture. It's like yours. It's like your guys. I said spousal RSP is good. Then your husband can deduct his income. Then also when withdraw as RSP after 3 years, then the income is you pay that income. So it's good because you have a low tax rate. That's the beneficial for your family. Basically, I'm talking about, but you need to wait for 3 years. That's what I said. Okay, you need to wait for 3 years. He said, yes, I could do it. Wait for 3 years. It doesn't matter. It's not big deal. I wait for 3 years. Then I said, but the spousal RSP is, when the people get divorced, they cannot ask that money back. So this money, if the husband contribution RSP in the wife's account, so that's he lost control for that money, basically. Okay, basically he lost control for that money. So the wife then that the money goes. The money goes. Then he just when you divorced, you cannot get, and the husband cannot ask the money back, and they just if they just talking about the property, so this property is out. Okay, is out. It's not the property for your couple. This money is out. Then he just one day he just come. Then when he back to home, he just asked. He just very mad of her husband. He said, "I know why you don't contribution your RSP, because you don't believe me. You said the money goes my account, then you lost your control, blah blah blah." Then he's come to her husband. Then the husband is one day. Her husband for me said, "Don't talk too much. Don't tell her lots of things." Okay, so that's the funny story. Okay, I think there's time to break. Okay, there's time for break. So anybody, if you have a question, please ask me. Then after break, we continue. Okay, I'm going to see you 10:15. Okay, let's take a break. Okay.
Okay, thank you. Okay, thank you.